Welcome to Weekly Sense, the first one of 2023. I couldn't be happier to be here. We've got some interesting things to look at this week. A lot has happened. Obviously, the start of a new year. 2022, the worst year since 2008 for the financial markets, not only the stock market, but also the bond market. Mostly influenced by the decisions at the Fed to control inflation. So we're going to get into Weekly Sense today. I'm going to share my screen, kind of go over a few things today to keep you up and apprised with what's going on in the markets. So I saw this. This is interesting. The Federal Reserve came out just recently and said that they plan to keep rates higher for longer and don't anticipate a rate cut all of 2023. So they'll probably get the federal funds rate somewhere close to that 5.25% or so is what they're estimating, and keep them there for most of next year. Now, this is the same Fed that told us that they didn't anticipate hiking rates more than a few times last year, but they increased interest rates all the way to 4%. So this is a picture of the federal chairman, Jerome Powell. Calm down. I just want you to lose your job. And unfortunately, that is the circumstances when you've got weakening economic deterioration, but you still have everybody employed. It's really hard to bring down inflation with everybody having a job and still spending their money. We've talked about that before. So I kind of wanted to go over some of the titans that really got demolished last year. This first one is a chart of Tesla with its market cap. Tesla's in red. Some of the other automakers down below, Toyota, Volkswagen, General Motors. I told everybody, right? Tesla was extremely overvalued. It was trading at 130 times earnings. It's now down roughly 70% from its high, completely demolished. Sometimes reality does set in, and people can make this about Twitter. People can make this about, selling his stock. Sure, those are parts of it. But the reality is that sales are slowing down. It's no longer a growth company. And, could it have a small bounce from here? Sure. But it's going to depend on how many cars they sell next year versus what they estimate. And what they came out with their fourth quarter deliveries were significantly under their projections. So you can kind of see, at the peak of Tesla's market valuation, it was combined total of all other automakers combined. So a company like General Motors or Ford generally trades at somewhere around 7 to 10 times earnings. Even after this monstrous clobbering that Tesla's received over the last year, they still trade at roughly 20 times earnings. So just be mindful of that. This next chart is of Amazon. You can see down about 50% last year. Amazon is now trading at its COVID low, same prices at its COVID low. But remember, they're a retailer. There's only so many people who can sign up for Prime accounts. And they hired a massive number of people over the last few years to keep up with the demand during COVID. And now they're trading back down to those pandemic lows. The chart doesn't look healthy. Amazon doesn't look healthy. And they recently made a few announcements that we'll get into here in just a few minutes. My one prediction this year, I think that Jeff Bezos will come out of retirement and go back as the CEO of Amazon before everything is said and done. Could be wrong, but that's my prediction. So with regards to technology, unemployment, we started to talk about that in the beginning of Weekly Sense. Since the beginning of 2022, the tech industry has laid off a total of about 154,000 employees. And typically when you are in a late stage cycle, the high flyers or the high growth companies are the first ones to see the dominoes fall, or they're the first ones to see waves of layoffs. And you're seeing that in the technology sector. About 154,000 people have lost their job in that sector so far over the last year. Most recently, Salesforce cut their workforce by about 10%. It's a huge layoff. Salesforce stock is absolutely struggling. And I wouldn't expect that, even a huge cut of 10% to really make a meaningful impact, at least in the short term. But you're starting to see a lot of these technology companies come out. Meta's come out, Amazon's come out. Salesforce has come out. Snapchat has come out. So all of these high-flying names that were trading at large multiples now laying off employees. And most of the time when they hire these employees, they give them stock-based compensation. And with their stocks down, 40, 50, 60, 70%, it's really hard to keep those employees there when most of their weight or most of what they would earn was going to come from stock-based compensation. And then just today, we saw Amazon slashed 18,000 jobs. Now, mind you, that's about 1% of their overall workforce. Amazon currently employs over 1 million people. So that 18,000 job is fairly small. I don't think that probably bodes well for the holiday season spending numbers that are going to come out in the next few weeks. But we'll see what happens with that. Here's an interesting chart. So the dark blue line is the ISM prices paid. So manufacturing prices paid. You can see from its peak in 2022 in the far right-hand corner here, it's really fallen off of a cliff. And history would tell us, this goes back to 2000, that inflation tends to follow these ISM prices. So by this chart, maybe by July of 2023, you could see inflation back down to 0%. Now, in reality, for that to happen, you really would need to see a pretty big increase in unemployment. So over the next, 6 months or so, are we going to see some significant increases in unemployment? That's possible. Maybe we have to, see even more further economic deterioration for that to come to fruition. I think 0% inflation by July is probably not going to happen unless something drastic changes in the economy and you start to see unemployment go up at a rapid pace. I do want to kind of close out this weekly sense just talking about a little bit about, the blessings of what this year has had that a lot of years haven't had. There hasn't been a time in the last 10 years where you can get paid to basically be patient. And as investors, we talk about being patient all the time, right? Waiting for that right pitch, watching for the fundamentals to improve. If you've been in our office, we've talked about the 8 signposts that we watch for to mark a market bottom. Only 2 out of the 8 that we currently watch are even checked off. So we're far from a market bottom, but going into 2023, it's the first time in 10 years where you're actually getting paid something to be patient. So as a firm, for a large majority of our portfolios, we've started to look to buy and add to treasury bills. So I wanted to show you here this 3-month treasury bill. A US treasury bill is issued by the US government, and it matures every 3 months. And currently it's paying about 4.5%. You can see that right there. A 1-year treasury bill is paying about 4.7. So in this uncertain environment, investors have an opportunity to, wait and be patient for the fundamentals to start to improve and actually get a decent rate of return of, somewhere between 4 to 5% interest. So it's an attractive place to be if you don't want to be taking the excess risk. And yes, there's a lot of names that are off significant amounts, but the next chart will kind of lead you towards, our direction of where we think the market inevitably is going to go. So we're going to jump back into the S&P 500 for the final chart. So this is the S&P 500 over the last 5 years. You can see the COVID dip right here in 2020, this massive acceleration. Remember, 0 interest rates, a lot of easy money, a lot of risk taking, meme stocks, things like that, propelled this market significantly higher. And then 2023 was defined by this down channel, retesting these lower high points and these lower low points. This blue line is the 150-day moving average. And what I've marked here, some channels, is the COVID peak, where we peaked prior to COVID. If you take that out over here, it's about 12% or so below where we're currently at. I think we absolutely retest those levels at a minimum. And the COVID low, depending on how bad the recession is, it's a possibility that you could retest those COVID lows. Maybe not a high probability, but it's a possibility. And that would be about another 37% down from where we're at right now. So all of last year, you have to remember that the decrease in the S&P 500 and the NASDAQ and individual stocks didn't have a whole lot to do with corporate earnings. It had a lot to do with resetting to higher interest rates, right? The higher the risk-free rate of return is, the lower something that carries risk becomes with regards to value. We call that multiple compression. But this year, it's going to be defined by corporate earnings. How in a slowing economy are corporations going to do with regards to reporting earnings? Well, if earnings season doesn't hold up, or if earnings are weaker than expected, then you could see a decrease in the market due to earnings, in the tune of somewhere between that 11 to 30%. Doesn't mean that it's going to go down in a straight line, but as investors, we want to be a little bit more cautious going into this new year for the number of reasons that I said. All right, that's it. I hope you enjoyed Weekly Sense, the first one of 2023. If you have any questions, make sure to reach out to us, and I look forward to talking to you again next week. Bye.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.